Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. Consolidation is the buzzword these days in the investment trust sector. We're seeing a lot of mergers, we're seeing trusts wind down, and we're seeing a lot of buybacks as individual trusts try to avoid having to give away their independence. So it seems a very good time to talk to a investment trust chairman and non-executive director who's been involved in a lot of this. And that gentleman is Neil Rogan, who is the chairman of two investment trusts. One of them is what we now call Invesco Asia Dragon, and the second one is Baillie Gifford UK Growth. And he's also a non-executive director of J.P.Morgan Global Growth and Income. And as he told the recent AIC conference that I attended, he's been involved in 6 mergers in the last 6 years. One of those was actually as the chairman of a trust that was being taken over. That was Scottish Investment Trust. And the other 5, he was on the board of trusts that were doing the consolidating. In other words, taking on the assets of another trust. And most recently, that has been the case with Invesco Asia Dragon, which is an interesting episode whereby Invesco has won the mandate to take on the assets of what was called Asia Dragon, which in itself was only recently combined with another then Aberdeen-managed trust, Aberdeen New Dawn. So clearly here is someone who has been heavily involved in what's going on, and it seemed therefore a very good moment to talk to him and find out his take on what the trends are, how long they're likely to continue, and what the pros and cons of all this frenetic activity are. Before we get into that, I would just like to mention that next week will mark the 5th anniversary of the Moneymakers podcast. Hard to believe, I know, but we have completed over 260 podcasts since then. We started it right in the middle of the COVID crisis. I started it with Simon Elliott, as some of you may remember, and that seemed a good idea at the time because we wanted to talk about why investors should not panic at that moment just because the equity markets were effectively falling out of bed. Well, they've obviously recovered strongly since then, and then more recently we've had the great unwinding of discounts, with the majority of investment trusts moving from a position where they were exceptionally, in historical terms, trading at a premium, and now where almost every trust is trading at a discount of some sort, and some of those discounts are very wide indeed. The average as of today is 14%, according to Winterflood Securities. So next week there'll be a time to reflect on all this. I shall be speaking at the Master Investor Show in London next weekend, where I will be doing a short 20-minute Q&A session with Simon Elliott up there to offer his perspective from his new position as a client director at J.P.Morgan Asset Management. So if you are interested in that, do come along. You can still get some free tickets to that event. There will be some other interesting speakers. A lot of investment trusts are appearing there. And Jim Mellon, who set up Master Investor, will be giving his annual take on where we are. Successful hedge fund manager and philanthropist. Always interesting to hear what he had to say. I remember 12 months ago, he was saying to people who attended, you've got to have a lot of gold and you need to buy defense stocks. Well, how right he was. Those two have been very strong performers over the last year, and anyone who took that advice would have done pretty well. So there we are. Master Investor Show next weekend and the 5th anniversary of the Moneymakers podcast. So my first question to you, Neil, is that you've been involved, as you noted at a recent AIC conference, you've been involved in 6 mergers as a director of investment trusts in the last 6 years. You have been at the front as far as consolidation of the sector is concerned. Was this what you expected 6 years ago?
No, it definitely wasn't. They've all sort of happened for individual reasons. It's not me being the vanguard of some industry trend or having an agenda to do anything in the first place. Just for their own reasons, they've happened. It's usually one trust is going through some sort of performance difficulties that will spark the desire for a merger, and then it kicks off from there. But you're right, I've done 6 in 6 years. The 6th one is live at the moment, which is JGGI merging with Henderson International Income. We've just done Invesco Asia with with Asia Dragon. 5 of the 6, I would have been on the board or chairing the board of the trust that was the surviving trust, if you like, the trust which the other one merged into. And one of them, which was the Scottish Investment Trust, I was on the other side. That was the trust that was struggling, which merged into JGGI. So I've seen it from both sides, and it is a lot of work.
It is, as indeed was discussed at the ISC conference I would mention just now. There was a question about, are you being paid enough to do this job? I guess the issue is that a lot of the time, I've been a non-exec director of an Investment Trust myself, it's a very important supervisory role, but you're not actually doing a huge amount of intensive work. But when you get involved in a merger or a wind-up or anything like that, then it does become very intensive. So is the answer perhaps to have some kind of contingent remuneration for these kind of things, so that if you are involved in an intensive situation, you do get paid more? Would that make any difference? Once you're there, of course. You can't just get out of the way.
You are. And I think it goes with the territory, really. I don't think that is a good idea. No, it'd be very difficult for me to justify that to the shareholders. The time involved in these directorships, typically when you're being interviewed, they will say 15 to 20 days a year is the amount of work to be a non-exec director. If you are chairman, that probably doubles. If you're involved in a merger, then for a space of 6 months, there are a hell of a lot of Zoom meetings and documents to read, and the workload probably doubles again. But the way I see it, it's part of the package, it's part of the salary. And for me personally, it's a way for me to put something back into the industry that's been very good to me over my fund management career, because I was involved in investment trusts from day one back in 1982 at Touche Remnant.
Right. I was going to mention that. So you are one of the chairmen of Investment Trust who actually was a fund manager before you became a director of an investment trust. But it was very different back in 1982. I think it's fair to say the world of investment trusts has changed an awful lot since then. I was around then. And as you say, you were working for Touche Remnant initially. Touche Remnant, of course, is no more in its current form. And the world has changed completely for investment trusts. Perhaps you could just briefly sketch out for us how it has changed over this intervening period.
Yeah, I suppose it has changed in a way. I mean, in many ways, it's still the same. Some of those same issues are around. When I started in the 80s, a lot of trusts were general trusts, and most of them were on quite big discounts. So there was a discount problem back then. And one of the answers was that trusts specialised. So a load of Touche Remnant trusts, I think it was true of Fleming's, where I went to next in 85. Instead of being a general trust, it became a UK trust or an American trust or an Asian trust. And that was the way of getting discounts down. And then, of course, over the years, there have been various issues there was a lot of activism in the 90s. There was the split capital problem in the noughties. It is a thing that discounts vary over investment trusts. And it is one of the disadvantages in some ways of the industry, but it's also one of the attractions because you have a chance to make money from that if you time it correctly.
One of the arguments that's always put forward is that the structure of an investment trust is preferable for a fund manager because you have, if not permanent capital, you have semi-permanent capital, and therefore you're not at the mercy of fund flows. Is that something you actually found in your own experience as a fund manager?
As a fund manager, it wasn't so much the flows. It's fairly easy to manage flows, even on a daily basis as an open-ended fund. But the great advantage as a fund manager was that you could use the gearing in the trust. If you can have 10% borrowing and enhance your returns by 10%, and you get that right, that makes a big difference to the performance of the trust. So that it was always the case over a long period that an investment trust should outperform a unit trust. So if you were a fund manager, you would want to be the investment trust manager rather than the unit trust manager because you knew it would do better. I mean, to compound that, the costs that are deducted from performance for a unit trust or an OIC are typically much higher than an investment trust. So again, you have that as an advantage. So if you get paid to perform, which fund managers do, you would choose an investment trust over an open-ended fund.
It's interesting that, of course, a lot of fund managers who do manage both, in terms of their own investment, they often prefer to put their money into the investment trust rather than into the open-ended fund. Is that a fair comment to the extent you're allowed to do that?
I'll take it from you that that's the case, but I can see why they would do it for exactly the reasons I've just mentioned. You'd be very sensible to do that.
Just while we're on this topic, do you think it's an oddity, though, that fund managers are not required to disclose how much they own in an investment trust unless they go above a certain limit, and obviously it becomes disclosable?
Yeah, that's a good question, actually, because that's come up quite a lot. I've been asked that a lot as a director now. It's the regulation for directors that you have to disclose your shareholding, and that's correct. For fund managers, if they're in their early 30s, I think it's a bit unfair to expect them to have a huge amount of skin in one game because they'd have too many eggs in one basket. in their own fund. They'll be paid. Their whole job depends on the performance of that one fund. So it would be taking a big risk if you've got a young family and a massive mortgage to back everything on one fund. I think that would be unfair, to be honest.
In terms of directors, though, obviously it's generally held to be the case that the more skin in the game that the directors have, the more likely they are to produce a good governance. Is that actually true in your experience?
I would say I believe that, but I can't quote any evidence to the contrary. So I've never seen any evidence that people not having skin in the game has been a problem. But it's a moral thing, isn't it? Morally, it feels like the right thing to do to me. For me personally, typically, whatever I get paid as an investment trust director, I will plough back into the shares of that company. And that just feels like the right thing to do to me.
Right. Perhaps I can ask the question differently slightly, which is you invest obviously in the trust you're on the board. Do you invest in other investment trusts as well? And if so, what kind of criteria are you using to decide that?
I've just invested in the 4 I've been involved with. They're the 4 that I hold at the moment, Murray Income being the one that I'm not on the board of any longer, but I still hold all the shares in that. I have dabbled in some others trusts in the past, but typically my own investments, I will hold the 4 investment trusts and, maybe about another 10 shares or so, direct company shares.
Right. Because obviously what I was getting at was whether skin in the game actually matters to you as an investor rather than just as a board member. Okay, so let's move on and talk about some of these activities you've been involved in. We know it's been an incredibly busy period, and there are reasons for that. We've had 3 years when discounts have gone very wide in the investment trust sector, and we've seen continued flight from UK listed equities in general. And we've now seen the emergence in public, anyway, of a noisy activist. There are other activists out there. If we just look back over the 6 in which you've been involved, before we come on to the latest one, is it always just about performance, or is it actually about other factors that have persuaded the market that it will allow you to go to a big discount, which is unhelpful to the shareholders?
I think in all cases, it's been performance and the discount. There's not been a big push from outside for one of the companies to merge with another one. But if performance has been poor over long periods and the discount has stayed wide, then I think as a director, if that happens to you, you start to feel the pressure that you have to do something. In the case of the Scottish Investment Trust, for example, where I was on that side, performance had been poor for quite a long time. A new manager had taken over, a very contrarian investment style after 5 years. So a fairly long period to start to judge that performance. It wasn't recovering. And then in particular, there was a period where tailwinds came into place. So their contrarian style should have done well for a year, and they didn't. So that was basically when the threshold was reached and the board decided they had to do something about it. So we started what is, it's almost like a code word, a strategic review, which is like putting up an SOS signal, basically.
Indeed. It's very rare that the strategic review results in the status quo continuing. Let's put it that way. And it's also the fact, I do know from my own experience as well, that you do get an awful lot of interest from other fund management groups who want to take on the assets of a failing, if you like, investment trust.
Yeah, well, that gave us to what you were saying earlier. The pool of permanent capital is very, very attractive, not just for the individual fund manager, but for the fund management company that runs it, because the value of that revenue is much greater because it's permanent capital than it would be for a hedge fund, which could be gone in a couple of months. So I think when we did the Scottish, we had about 30 companies apply when we put the message out. I think we ended up getting RFP, so sort of 30-page proposals from about 18 of them. And it's a very, very competitive process.
Well, just on the Scottish, just before we move back on again, I mean, did you not feel a slight sort of twinge of regret there when, I mean, the Scottish is one of the very old investment trusts, has been around for decades, if not even longer, as I recall, that you had to put this failing veteran out of its misery?
Yeah, I did feel bad about that. And some of the Scottish holders were asking a similar question as, a Scottish company being taken over by an English company. And I did feel a bit guilty about that when I'm English, so it's not for Scottish reasons. But Murray Income, when it took over Perpetual Income and Growth, Murray Income was a Scottish company taking over an English company. So at least in that difficult question, difficult answer thing, I feel like I'm one on each side.
A very diplomatic answer, that one indeed. Well, let's talk about your most recent deal, which is now becoming Invesco Asia Dragon. This is a curious one, curious in a number of ways, because the entity that you have merged with and effectively put your manager in charge of was much larger than you, first of all, and secondly, it only just recently completed its own merger with another trust from the same stable, that was Aberdeen. So Tell us how that process developed. So when did you decide you wanted to have a go for that? And what gave you the confidence that you could win despite being a smaller trust than the one which you were merging with and effectively taking over?
Yeah, it's a good question. We were told by our advisors to start with that you can't merge a small investment trust with a big one. And that also you couldn't merge two investment trusts that were both on a discount. So from the off, we were told it was almost impossible, which became part of the challenge, actually. How it started from our point of view is that Invesco Asia Trust had a very strong team behind it in terms of the fund managers, very strong process and people. And it also had a very good performance record and a very good risk adjusted against the index over 3, 5, 10 years and beyond. And we had some very good relationships with shareholders. We were on buy lists for some of the wealth managers. And the wealth managers said, well, we love you, we'd love to buy you, but the problem is you're too small and we're already maxed out. We literally can't buy anymore because we're at our limits. So we're sort of thinking, okay, well, how do we fix that? And the fast answer is to grow, to find a way to increase the size. So we had it in mind that we needed to grow. We were looking around. We had some discussions about who might be potential targets or partners. And Asia Dragon came on that list. And then they announced the merger with Asia New Dawn, as you say. We didn't know anything about that until they announced it. And it was something that we would have liked to have got involved with at the time, but didn't get the opportunity. But then when about 9 months later, Ashoka came in with their unsolicited bid for Asia Dragon, that became the opportunity because Asia Dragon very quickly put out the strategic review message and we were ready. So I wrote to the chairman the day that came out and we were invited to submit to the process. It goes through this big process they use Sanhope as a consultant. I think it took 5 months or so from the request going out to them actually choosing who the winner was. And there was a lot of work there, but basically it was the people, the process, the performance, and what we as a board were proposing in terms of what we call the corporate proposition. And that won the deal, but that was a competitive thing. So as I mentioned earlier with JGGI, there were probably about, I don't know the number for Asia Dragon, there would have been 25-ish companies bidding. Some of them who did have an investment trust, some of them who didn't. And we had to beat all of those to win.
So what do you think it was that tipped the balance in your favour, as far as you can tell?
So there's a couple of things. The consultant would have been very hot on performance and process. So very strong risk-adjusted performance, which the Invesco team in Hargis, Fiona Yang have. If we didn't have that, we'd never have got anywhere at all. I suspect there would have been a couple of others who were quite close to us in those respects. And the tiebreaker, I think, probably would have been the thing that we did that's different, very different, is that we have the 4% unconditional tender offer 3 years out. That was a new thing. And that is aimed at basically stabilizing the shareholder register going forward and facilitating the growth of the company. Because suddenly anyone thinking about buying Invesco Asia Dragon knows that they could sell as much as they like of their holding in just under 3 years' time now at a 4% discount. So the certainty. So for all the shareholders, when we were trading at discounts between 8 and 12%, the fact that you can get out at 4 is clearly in shareholder interests on that respect. And the other part about it, and the acid test will be where this actually happens, is that when you're faced in a couple of years' time with that choice of coming out at 4%, would you actually do it? And that's the interesting thing, because we hear from our smaller shareholders, the individual shareholders, the smaller wealth managers, that they do view this as a form of permanent capital. They would like to stay in. And they get a little bit miffed when the more activist shareholders are pressing for tenders or things that they don't particularly want. So it becomes quite a clear choice. In 2 years' time, you can stay in the trust. You can come out at a 4% discount. Clearly, if you stay, the 4% that people tendering lose, it's a zero-sum game. That goes to the people that remain in the trust. So we think that even the larger shareholders, even the big shareholders that we all talk about, there is incentive for them to retain some or part or all of their holding at the time, because again, the 4% applies. It's a rolling thing. It's in 3 years' time. And the big ones claim that they want to stay in the sector. They want liquidity in the sector. Their bread and butter is to invest, particularly in Asia and emerging markets, investment trust space. So if all the trusts disappeared, they'd have nothing to do. Their own business would fall over. So what they want is good trusts that continue, that perform well and have a predictable discount. And that's what we now have.
Right. This is very interesting, the terms and so on that you came up. So, in order to get this deal done, what did you actually change in terms of the structure and the incentives that you had before to what you have now after the deal?
It's really just the one thing. We are a little bit more active on buybacks now, but that's the whole industry. So that's not really the deal. The change was that Invesco Asia had continuation votes every 3 years. And we had a 25% 5-year performance conditional tender that we put in place 4.5 years ago, and performance was way ahead of target. So that wasn't going to be triggered. So those are the two that we did have. They've both now gone and been replaced with what we call the 100% unconditional tender. So it's every 3 years at 4%, but 100%. That has been popular with the shareholders. Obviously, we took some soundings before we announced that. It has gone down very well with the industry. One of the interesting debates at the time was, should it replace or be in parallel with the continuation votes? And one of the things we struggled with as a board was sort of reconciling it. If you had the two in parallel, then we went through some war games as well, when would you have the unconditional tender in terms of, would it be ahead of or behind the continuation vote? And what if people voted to take all their money out of the trust and then the continuation was later and they decided they would vote against continuation? That wouldn't really be fair on the remaining shareholders. And if you play it the other way around, you get the same problem. So we felt that actually the fairest way of treating all shareholders is that the continuation vote is removed and everybody has the same option to liquidate 100% of their shares if they want to at 4% every 3 years. So that was the change.
And do you think that is a good template for the industry as a whole, or at least the equity investment trust? Because, historically, I think obviously continuation votes have become more common, but conditional tenders or performance-related tenders are perhaps more popular. They are perhaps a bigger threat to the fund management company. If they don't perform, they could lose the whole shebang, so to speak, and maybe that was a factor before. In one sense, do you think this is a template that will now be followed by others, if I can put it that way?
Yeah, I think it probably will be. The proof will be what actually happens a couple of years down the line. I think it does require quite a lot of confidence on the behalf of the board, obviously, but also the manager who you would want to support the move. If you didn't believe in your future performance or your ability to grow, then you would have less confidence in this. But we're confident it will work and it is the best thing to do. I remember saying to the chair of Asia Dragon at the time that the worst case for us was if all the activists leave after 3 years and we're left with a £500 million trust with a very clean register on a small discount. So the worst case actually was quite a good outcome. So once you think of it in those terms, you're not afraid of the worst case anymore, then it becomes much easier to move in that direction.
One of the problems with performance-related tenders is that, of course, it can be quite arbitrary when the date happens. It can be arbitrary, and we know that particularly over 3 years, it's not necessarily long enough to judge a performance if the style is out of favour or in favour or whatever it might be. Do you think that performance-related tenders, therefore, are perhaps not as good a mechanism as the one you've chosen?
There'll be circumstances where they're preferable, I'm sure. It's less that, in my mind, what gets difficult is when it's a fractional tender, if it's a 25% tender or a 15% tender or 50%, whatever the number is, because what you see happen is that you get to a starting point where some of the shareholders want to get out, some of them would want to stay in. They might both be activists, but just have different views. But if one of them tries to liquidate their entire holding, so if there's a 50% tender and they bid their entire holding on the hope that they get oversubscribed, then their competitors, the other activists, basically have to do the same thing. Because otherwise, what happens is the first one would get a bigger than fair share tendered out successfully, and the other ones would have a smaller amount, and they've lost out. And I've had some clients say that that's almost against the rules of best execution, which I'm not quite sure that is the case, but I can see why they would worry about it. So the big shareholders get in competition with each other on these things. So with Asia Dragon, for example, there was a 25% cash exit on the merger, and I think it was more than twice subscribed. But we've already seen that some of the shareholders that sold out in the tender have been buying shares back in the meantime to get back to where they first started. So I think they only do it because it's a fractional tender. I think having 100%, again, we'll see, not many trusts have done this sort of thing before. It changes the dynamics of the game. So it'll be interesting to see.
I suppose the point is you can't necessarily infer that just because you've got a bigger tenor than 25%, that actually that percentage of the shareholder doesn't actually want to continue in that trust. It's just they're playing this game. Effectively, they have to play to protect their relative position, essentially.
They do, particularly if they're in competition with each other in terms of performance.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to J.P.Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favourite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. So that brings us on then to Saba. Obviously, you've been observing that, I think, with interest. How far is the kind of consolidation we're seeing being driven by Saba or some of the other activist investors who we don't see in public? In other words, are boards being pushed into doing things that they perhaps could have done earlier? Or is it just a happy coincidence they're doing these things now?
Well, in our case, it's not at all. There haven't been any Saba holdings, so it's completely separate in terms of what we've done. As I said, we've just worked out from the individual trust point of view what is the best thing to do for shareholders. You have this mandate as a non-executive director that you have to look after the interests of all shareholders as much as possible and as many shareholders as possible at the same time. So that's what we're trying to do. And the performance and discounts and fees are the three big levers that we can control. So if we can improve any one of those as directors, then it's our job to do that. And I'm a very strong believer in that. And, you're allowed a maximum of 9 years on the board of an investment trust, and you want to get the biggest impact you can in that 9-year period. So that's what we're doing. In terms of the overall industry, the fact that perhaps with Invesco Asia and Asia Dragon, we've set a template that others could follow, then maybe there will be more trusts that go down that sort of route. The Saba thing that's interesting now is that in my mind, and I haven't had any direct contact with them at all, so this is just opinion, they've almost got stuck in some of their holdings. They've got big stakes in quite a lot of trusts now that are not particularly liquid, and the premiums, well, I think they did buy successfully on quite large discounts to start with, but some of them, as they've topped up those holdings, the discounts are much smaller and they will struggle to get out. The BlackRock deal that they did, or the moratorium, whatever it was called, I'm not sure whether it has an official title, was very interesting because BlackRock run a lot of closed-end funds, both in the UK and in America. So to offer not to intervene in any of those trusts was quite a big thing that they were giving up. And it did make me think, well, why would they do that? And one of the reasons appears to be that they have a need for liquidity. And the quid pro quo for that deal was that 2 of the BlackRock funds were offering big tenders, and so we're able to take out a lot of cash, and that helps keep them going. But if they get into a position, I used to run hedge fund money, and if you run a hedge fund and you promise 20% a year, and then you're down 2 months in a row, then your holders get quite anxious quite quickly, and the prime brokers, because these hedge funds are all leveraged, they'll get quite anxious quite quickly as well. And it's not necessarily sustainable for very long. You can get away with it for a couple of months, maybe even a couple of quarters, but at some point it starts to go into reverse, and the need for liquidity will get larger and larger.
So does that mean it becomes a sort of game of chicken then after that? Because suppose your trust did have Saba on your register, and obviously I know you've performed so well that it hasn't happened. But if it had happened and you had Saba on your register and you'd been through this process that some of the other trusts have been through, the 7 and some others which are behind them, how would you think about dealing with them? If they lost their first vote, they're still there, they're under pressure to sell their stake, but there's no liquidity, as you say. As a board or as a chairman, what would be your approach to that? I mean, you want to treat all shareholders fairly, but it's quite difficult if you've got an unwilling shareholder on your register who is effectively fouling up the market, if you like.
Yeah, I think you probably answered the question already, that you do have to treat all the shareholders fairly. So you need to make sure that whatever you do or don't do is in the interests of those shareholders as well, hopefully, because in the perfect world, you'd be able to do something that was suitable for everyone. This, again, is you go back to the point If a big shareholder pushes for a big tender, then some of the smaller shareholders may not want that. They might want to stay in. So it's difficult. It basically takes a lot of time. Time is probably Saba's enemy, but boards don't have infinite time to react to these things because we're all subject to annual re-election, for example, as individual directors. But time is probably the biggest enemy.
So if you're sitting on the board or you're the chairman of these trusts, you want to get rid of Saba, but you would prefer it if they got rid of themselves, presumably. That would be the best outcome as far as you're concerned, if you don't have a mechanism for, if you like, buying them off at a price which is not available to other investors.
Yeah, well, the best outcome is if whatever corporate shareholder it is, if they sell out at an acceptably small discount from their point of view. That is what everybody would want. The directors, I'm sure, in the trust in those positions that would want that as well. It's quite difficult to pull off, though. That's the thing, because it's just the nature of markets. I know as a fund manager, if you're interested in a particular company and there's somebody who owns 30% of it who you know is a forced seller, then you're not going to step up straight away and buy it off them immediately at the current price. You're going to wait for a chance to buy it cheaper. Something might happen, some event might happen. You'll get a chance to do it later, or maybe typically companies would do, I'm not talking about investment trusts here, companies would do with placements in the UK market at a 5% discount. So there are all conventional ways in which these things can be done. But yeah, if you were the next buyer of some of these trusts, you would wait.
So that is a problem. I mean, it's easy to say that the best place to start from would not be starting with a big discount that allows this opportunity to arise. And perhaps you could argue, and many people do argue, I think, that for whatever reason, maybe in a combination of external factors, obviously, but maybe the boards of a number of trusts have been a little too casual about the fact that the discount has widened so much and not preempting the kind of issue that we've had.
Yeah, I think that is a fair comment. I think boards in some cases did let discounts go out too far and stay out too far. And as directors, that's our fault because that's our responsibility. We didn't need to do that. And some trusts have reacted better than others in that respect. So it's a fair comment.
So looking at Invesco Asia, have you said there is a discount target? I think historically you have said something, but what's your position on that? I mean, you're currently trading, at a discount around 10%, I think.
Yeah, I mean, the market's a volatile moment, somewhere anywhere between 8 and 10 for the last couple of weeks. Yeah, we say in the annual report, we have said this for a long time, that we want the discount to be on average below 10% over the company's year. That hasn't changed. That's still there. That will be in the next annual report as well. The 4% unconditional tender 3 years out becomes an anchor, I think, for expectations. So, I'd like to think that over the next few years, we will trade somewhere between 10% at one end and a small premium at the other end. As I mentioned earlier, one of the things that we're starting to see happen now is that the big wealth managers who had us on a buy list, they can now buy because we've got the extra size. I know from previous experience, particularly with JGGI, that buying takes a while to come through because it's controlled by lots of individual managers, even though there is a central buy list. It's not the buy list that puts the transactions on, so it kicks in slowly over time. So that's quite a healthy place to be from our point of view, because the other thing we know, as well as being on the buy list, we know that most asset allocators have a very low weighting in Asia at the moment, because Asia's been out of favour for quite some time. So all it takes is a little bit more optimism on Asia, or perhaps just a little bit less optimism on America, where everyone's been parking their money in the meantime. And if you imagine if people doubled their exposure to Asia, I don't know what the numbers actually are. A lot of people are probably something like 2%. So they go from 2 to 3, 2 to 4, 2 to 5, all low in terms of historical context. Then that makes a big difference to fund flows into the sector and should make a big difference to all the discounts in the trusts in our sector.
Yeah. So the effect of the deal has been that you are sort of catapulted you're now the largest in your sector, which is the Asia Pacific equity income sector. And so that's given you, as it were, a competitive advantage against some of your peers, though I've noticed that your discount is wider than most of the others as of today. But you're saying that you would expect that to normalise over the next period, the next years, and certainly before you get to your 4%, there'll be a kind of pull towards 4% towards the end, even if you don't do well.
Yes, exactly.
Okay, so let's just quickly talk about JGGI. You're a non-executive director there, you're not the chairman, but JGGI has been extraordinarily successful as a consolidator of the sector. You mentioned they took over Scottish Investment Trusts, and they've done at least 3 others, I think, since then, and are currently in the process of completing the 4th. Obviously, their performance has been very good as well. How important to their success do you think the enhanced income policy has been, by which they pay out a fixed proportion of NAV as a dividend, 4%? Is that being a factor? Does that actually give you what I think corporate finance would not suggest you should be able to have, which is a kind of best of both worlds, if you like, as a shareholder?
Yeah, I mean, it is a controversial subject. I think, in all honesty, in their case, it's an absolutely essential part of the whole thing. I think if they hadn't done that, none of this extra growth and acquisition success story would have been possible. And it transformed JGGI when it was done. When I was at Fleming's back in the 80s, when it was called Fleming Overseas, it would have traded on a 10 to 15% discount for a long time. I think it was on 10 or thereabouts up until the point where this enhanced dividends policy was put into place. And then once it was announced and implemented, I think it took about 6 to 9 months to percolate through in terms of maybe attention or people getting comfortable with it. And the shares have basically traded a small premium for most of the time since that's happened. If you pin one decision that transformed JGGI, that would be it.
And yet, looking across the whole sector, I think there's only about 25 trusts or so which do pursue an enhanced dividend policy. Obviously, certain trusts don't have that option because they can't do that. So do you think that's another model for the future that others might want to emulate?
Yes, I do. I understand why some people don't like it. But with Invesco Asia, we blatantly copied it 8 years ago, and we do the same thing. It was interesting because with Invesco Asia, the idea there was to pay 4% of NAV out in 2 installments, so 2 and 2 over the year. And when we first mooted it, my board didn't really like the idea. The manager didn't think it would make any difference. The broker said the shareholders, there's not much support for this. They think you're sort of changing the game, you're bending the rules a little bit. And it was quite hard to get it through. It must have taken, 3 board meetings. So that's sort of 8 months to get everyone onto the same page and do it. And then it was one of these things, a year later when we went around the shareholders, because we always, between the annual report and the annual general meeting, I will go and meet as many of the shareholders as I can. And I must have seen about 15 that year. And unanimously, they said, oh, yeah, well done on the dividends policy. We think that's a really good idea. And I'm thinking to myself, okay, well, thank you very much for saying that. But that's not what you said first time round. And it's universally popular after you've done it and not at all popular before you do it. And I think that's probably why a lot of other trusts haven't done it. And I would say to them, just do it anyway, because everyone loves it once you've done it.
Okay. Let's talk also then about another trust you're the chairman of, and that is Baillie Gifford UK Growth. I mean, Baillie Gifford have been very interesting. They manage a lot of trusts, and we know they have some very high-profile ones, including Scottish Mortgage and Monks and so on. And they've been on a roller coaster, I think it's fair to say, because they have a specific style of management, very growth-oriented, relatively concentrated portfolios. And they also have become sort of cheerleaders for the idea of holding private assets in a liquid investment trust structure. You've only been chairman there since last year, 2024. What are the differences between managing a trust like that, which has got this particular style that has been very much in favour then very much out of favour? How do you think about that as the chairman of a board? And if the market pushes you out to a big discount, which has happened to a lot of Baillie Gifford trusts, is that something where you would want your shareholders to be understanding and give you a sort of dispensation? Or can you not afford to ignore that happening?
No, you can't afford to ignore it, certainly. When I joined that board in January last year, became chairman, as you say, in August last year, so it's early days for me. It was very definitely a turnaround situation when I joined it, and the other directors recognised that. It's got some good things going for it, which we can touch on in a moment. It's almost a unique trust in the UK because there isn't really another out-and-out growth trust in the UK. So if you believe in UK growth, and I know a lot of people don't at the moment, but if you did believe in it, then this would be one of your first ports of call. But as you say, it had been a roller coaster. What was interesting to me was it looking 18 months ago, the performance over 3 years and 5 years was shocking, frankly, a long way behind the index. And then when you look at it in a bit more depth, it was really 2021, 2022, so just after COVID, where what had been a very strong tailwind for Baillie Gifford's investment style became a very strong headwind. And this UK trust, and indeed a lot of the other Baillie Gifford funds, had a very poor period at that time. The nice thing, when I first went round the Baillie Gifford UK shareholders, one thing that surprised me was that they nearly all understood the Baillie Gifford style, and they nearly all understood why they'd had difficulties in the last couple of years. And a couple of them volunteered this phrase that I've repeated many times, where they would talk about trough Baillie Gifford. We're already past trough Baillie Gifford. And that was very interesting to me. That was encouraging for me for a start, because it made me think, okay, there's hope here. We can revive this trust and put it on the front foot again. And basically what it needs, if we get growth in the UK economy, so there's a big if to start, but I've been quite encouraged by what's been happening in UK politics the last couple of weeks with all this idea of Trump-style cost cutting, because suddenly we might actually get some growth, maybe completely for the wrong reasons or the opposite reasons to what we expected, but it doesn't really matter. If you get growth, then it's a good thing for this trust. The Baillie Gifford style was out of favour quite badly, but would definitely benefit from recovering growth, because they do well in bull markets. They do well when growth is accelerating. And there's the discount issue as well. This trust was trading on a discount of sort of 14, 15, 16%. Not too long ago, we announced a policy that we intended to maintain it within single digits. That has made a difference. So we are now in single digits. Last year, we announced 100% performance conditional tender that will run to end of April 2029. So again, it's almost, this trust becomes an each way bet, because either it performs well, and if Baillie Gifford do well, you'll make quite a lot of money on it. If it doesn't do well, you get the chance to get out at NAV in 5 years' time. So it's quite a nice each way bet on the UK economy. And if we do get this idea of back to growth in the UK, back to basics, Baillie Gifford, I would call it, then Baillie Gifford UK Growth becomes quite a powerful message.
And would be differentiated by its extreme growthness, if you like, out and out growth. But just in terms of the tender offer, 29 is quite a long way away, right? It's still 4 years away, and you've been through this period of bad performance for quite a few years, and it is a performance conditional tender. But it is 100%, and it is at NAV. Is that what you've promised?
Correct, yeah. Less costs, yes. So very close to NAV.
Okay, so that could be potentially terrible, right? But still, you have a market cap 235 million, something like that. That's still quite small by the metrics required by wealth managers and so on. So might you have to consider other solutions as well if you don't just get that growth?
Yes. To answer a different way, I know how to make it bigger.
Okay. You wouldn't want to share that with us at this point, perhaps, but I think I hear what you're saying. Okay, so looking across the piece now, then we're getting near the end here, but what's your thoughts about the sector as a whole? As it happens, you're involved in 3 very different trusts, different geographical focuses, different styles, income, growth, whatever. So you're seeing across the whole market, I think it's fair to say. Are you one of those who thinks that the trust industry is facing an existential crisis?
No, I don't think of it as extreme as that. No, there are clearly difficulties going through at the moment. The whole cost disclosure thing is occupying a lot of time. And, whether we get the right solution or not, we will see. And it clearly does affect anyone who's charging their clients a fee and then investing in investment trusts is going to be affected by this one way or the other. We can't do a lot about that other than go to fair disclosure. I suppose the thing that I would ask for is just a level playing field. As investment trusts, we're all fully transparent about the costs that we have, and it's our job as directors to keep them as low as possible. It is irritating whenever I watch football on TV, the amount of betting adverts you have trying to tempt people to waste their own money on stuff without disclosing the costs. You get on the tube and there are crypto adverts everywhere, which is almost completely unregulated. It's not fair. It's not a level playing field with us as investment trusts, because we're regulated and everything's clean. The worst example is anyone who goes on a holiday and goes to get some foreign currency. You'll see it. You go into whatever it is, exchange company, and they say, oh, there's zero commission. Yeah, well, that must be good. And then there's a 20% spread between the bid and the offer on the currency, and no one talks about it. And that's absolutely scandalous. And, in investment trusts, we've got ongoing charges, probably for my trust, they're typically, JGGI is 40 something basis points. Invesco Asia, Baillie Gifford UK, both 70 basis points. So 0.7% is basically the round trip cost on holding those things for a year. And you go on holiday, buy US dollars, you pay 20% just for one trip. It's not fair. It's not right.
Well, it's not fair, and it's certainly not helpful if you're trying to encourage enterprise and growth in the economy, which is, of course, what the government says it's going to do. I do totally agree with you. It is bizarre, but the FCA seems to be, like all regulators, maybe it's going to do something once it gets the memo about now we want you to consider growth as a factor. But it is curious, isn't it? I mean, as you say, listed investment trusts, shareholders have extraordinary number of protections in law already. But it does seem to be the desire for the regulators to standardize in some way, to put everybody into the same regime, even though they're very different. And investment trusts are, by definition, they're kind of hybrid. They're not exactly funds, but they're not exactly shares either. They have those two features in common. So it seems to me to be something of a regulatory blind spot. I don't think I can even put it in no other way than that. But perhaps I shouldn't ask you to comment on that because that might get you in trouble. But am I not right about that?
Yeah, I think you are. We don't quite fit into the boxes that are being created, so it becomes a bit difficult to solve. Maybe we just need a box of our own. Maybe we don't need to be in a box.
So the final question then, we're looking ahead, and well, you're a professional fund manager, you were. How do you interpret the world at the moment? Have a quick comment about the effect that Trump and his administration is having on global markets. Obviously, we've seen equities have sold off. Bond yields have not gone down as far as some people were hoping, and indeed gone up in places. It's not particularly encouraging if you're trying to encourage people to come back into the kind of vehicles that you chair.
Yeah, it's difficult. I accept that. The way market sentiment appears to be, to me, is that most investors are worried. They might be worried about different things than they were worried about 6 months ago, but they're still worried. And that's not a conducive environment to big bull markets and things. The thing I find fascinating, if I could put a number on it, I would say in terms of how optimistic people are, on a percentage scale, I'd say maybe 20% is the number at the moment, it feels. When I look at what's actually happening with whether it's the UK's growth policies or China's stimulus policies or Trump's cost-cutting or tariff policies, with my sort of economist training on it, I would say it's 50-50 whether those policies work or not. It's not clear, but they're not necessarily bad things. Tariffs, basically, I did a lot of training on this when I was at Cambridge because all my teachers at Cambridge were massive bulls of tariff policies and incomes policies back in the late 70s, early 80s. The tariffs are basically a zero-sum game, so there are winners and losers. So 50-50 is quite a reasonable starting point if you're trying to work out, is it going to be successful or not? But if there's a mismatch in those numbers that I've just said, because if people are 20% bullish and there's a 50% chance that things work, then there's room for positive surprise. What I would say, there's one of my former colleagues back at Fleming's used to have this concept of the wall of worry, and equities basically climb this wall of worry. We've got a very steep wall in front of us, but we are, I think, climbing it. And by the time where nobody's worried anymore, the bull market will probably already be over. So I would be optimistic. I am personally bullish, and I'm fascinated by all these different things going on. But politics is a lot more interesting than it has been the whole of my career. We always used to say, just ignore politics because it comes out in the wash. And that's definitely not the case anymore. And it's fascinating.
It certainly is fascinating, but you'd also still say, would you, that the investment trust structure is still one that you can have confidence in, particularly when discounts are at this sort of level over a time. If your more optimistic scenario works out, would you expect discounts to improve? Obviously, there's some very extreme examples, but in terms of the average equity investment trust, if it's got a decent discount control policy, you would expect them to be able to sustain that over time and therefore not give you necessarily the volatility that we've seen.
Yeah, they would improve in that scenario. I mean, by the time you get to the top of the wall of worry, then most trusts probably won't be trading on much of a discount at all. That becomes a different problem at that stage, but the journey from here to there should be a very rewarding one for all investment trust shareholders.
And is it mandatory, effectively, for investment trusts that have issued shares at a premium to implement a discount policy that, if you like, gives some of the money back when the demand is not there?
Yeah, mandatory is not the right word, but there is a very, very strong moral obligation to do exactly that.
Okay. Well, thank you so much, Neil, for your comments. That was Neil Rogan, who is chairman of two investment trusts, Invesco Asia Dragon and Baillie Gifford UK Growth, and a non-executive director of J.P.Morgan Growth and Income Trust.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.